then we'll get started. Somebody throw in the questions box that you can hear my voice right now. All right, they got us. We're good. All right, this is Bob Iaccino of Path Trading Partners. Thanks again for being here. Thanks to Nadex for having us. And this is Nadex Spreads Class 4 Part 2, Understanding Nadex Spread Greeks. As always, if you guys haven't seen the earlier series that we did on this particular subject, you could go to nadex.com and go into Learning Centers. Actually, let me show you guys this. It'd be easier if I show you guys this, right? So here is nadex.com. You go into webinars or into Learning Center, either way, but you go to webinars here, and you can see all the other Nadex spread ones that we did, which are better than all the others, which you would expect me to say, but I think they're better than all the others. And so I think you should listen to all of ours first. As a matter of fact, ours. All right, I'm being funny, I'm sorry. Nadex only associates with reputable educators. But this is Class 4, Part 2, Understanding Nadex Spread Greeks. And before I start, as always, let me go into a quick risk statement. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction, which is true because we're not going to give you any kind of special offer to buy at the end of this. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. Real quick, because we take the risk disclaimer very seriously, I want to touch on something. We actually got an email from a member this week, a member at Path Trading Partners, asking us about how much money is realistic to start. And that's a very common question. I'm sure a lot of you are thinking that right now. Well, yeah, I'm going to learn about spreads and I want to trade them, but how much money do I need to start? And I want you guys to stop focusing on money basically from this point on. What you want to focus on is learning your trading method. What people don't understand about trading is that money comes from taking the proper actions. It doesn't come from the amount of money that you have in your account or the amount of money you place at risk. The particular trading method you decide to apply into Nadex products is what determines how much money you need to place at risk to achieve the goals that only you know. We don't know what your goals are. Are your goals to just pay your car payment with your trading? Are your goals to take a couple of extra vacations a year with your family? Are your goals to quit your job? We don't know any of that. People ask us these questions all the time. We did a webinar for Trading Pub this week and had a guy come in and say, what is the exact probability of what you're talking about? And there's no way to do that. No honest trader will ever pull you aside and say, you can make X amount of money if you do this. Because it's simply a statement that can't be made and be truthful, not in the blanket form that I just made it. So take these risk disclaimers seriously. Don't just gloss over them. The statement that's up on your screen right now will actually save your financial life. And I'm not kidding about that. So be very serious about the amount of money that you place at risk and what that amount of money means versus your own financial situation. It's not a joke. This is actually real trading. Who is Path Trading Partners? We are a trading and education firm. Yes, we do trade. PTP's mission was to form a trading firm that educates, supports, and backs traders who are committed to probabilities, discipline, and long-term trading success. We do provide seed capital to certain types of traders in certain locations. That is something we do as a firm. We're not just an education firm. But we only do that with traders that are committed to doing things the right way, and that's consistency and long-term success, not short-term gain. This is achieved by following the correct path. We are not high-frequency traders, as I think I just explained, and we are not day traders. We are a firm that believes in a long-term success in trading, covering time frames dictated to us by products, markets, and price action. What does that mean? That essentially means that the market tells us what we can take from it, and we only take what the market gives us. We don't come in with the idea that I'm going to do X today. We come in with the idea that I'm going to do X over the next 2 to 5 years. That's what we do. Mike Arnold is a 23-plus year market veteran who's been teaching traders online and in person for over 10 years. He is a strategy and development consultant to multiple hedge funds. I've explained this in other webinars, so you're going to hear this again if you listen to the recordings, but Mike's job is basically a professional devil's advocate. Hedge funds will call him up and they'll say, Mike, we've developed this particular trading method or trading algorithm. Can you please break it for us? Find the holes in it. And that's what he does, outside of what we do with Pat Trading Partners. He's a former options market maker on multiple exchanges who has traded in Chicago, New York, Switzerland, and Canada. And he is the current head of technology and trading system development for Pat Trading Partners, as well as being my co-founder and my friend. This is me. That's my hideous face in the pretty pink shirt on the right-hand side. I've been around for about 23 years, done commodities, futures, forex, and I've done individual stocks for myself. And I've been teaching and mentoring traders both live and online since about 2002. I have been an analyst, a proprietary trader, a risk manager, a fund of funds, hedge fund principal, and a member of the investment committee on that fund of hedge funds, which I think is where I bring you guys value. To date, I've taught and mentored over 5,000 students. And I've appeared on all the stations you see that I don't really care about. You can watch a recording if you care about that. I continue to appear about 5 to 10 times per month. I've done about 800 interviews at this point between the different business news channels. I will be on Futures Now Thursday at, I think it's 12 o'clock. CNBC Futures Now is it's an online show, but they may use the clip on their website. Don't really care. Let's talk about the prior class. The last time we covered an overview of Greeks and the concept of delta and gamma. We investigated how delta and gamma reacted to time and volatility. We saw how for delta and gamma, volatility and time have the same effect on the spreads. In this session, we're going to finish covering the concept of Theta and Vega, so the 4 main Greeks that you need to know or need to understand to become proficient at trading spreads, and how time and volatility affect the pricing of the Nadex spread. Now, we know this is advanced information, and we will take some time to absorb it. This is why we're taking our time and teaching it. This is why we broke this down into part 1 and part 2. The Greeks are hard, and you don't need to know the exact level of the Greeks to understand how they affect the spreads that you're trading. So here's a quick review of the Greeks. The definition of each Greek is as follows. Delta is the sensitivity of the spread price to the price changes of the underlying. Gamma is the sensitivity of delta to the price changes of the underlying. How is the delta moving? Obviously, if the delta is moving, then the spread price is moving at a quicker pace or a slower pace versus the underlying than you originally anticipated. So that's what gamma is. How sensitive is the delta to the price change of the underlying? Theta is the sensitivity of the spread price to the passage of time. Extremely important for short-term vehicles like the spreads. And Vega is the sensitivity of the spread price to the change in implied volatility of the underlying. There's another Greek, it's called Rho. It's the sensitivity of the spread price to the changes in the interest rate. We will not be looking at Rho, since Rho will not affect the price of the spread the majority of the time. Interest rates are not going to change so quickly and so often that you really have to understand what Rho is. So here is a basic risk graph of spread price versus the underlying. What you're seeing here is what the graph looks like at expiration. Here, this line down here represents what the spread does. This is essentially a 100 to a 105 spread. And this blue line represents the way the price would react at expiration at the different price moves of the underlying. So here's the price moves of the underlying, and here's the price of the spread itself, and here is the underlying down here, and this is the spread representation, 100 to 105. And this is representative of what the price curve would look like with about 30 minutes to expiration. You can see there's gaps in different areas of this particular risk graph. I'm going to give the control over to Mike here to talk more about this.
Thank you, Bob. Great introduction. So, last week we went over the delta and the gamma. This week we are going to go over the theta and the vega. And these are two of the easiest and most useful Greeks to understand. Okay, theta models how the spread price will react in regards to changes over time. Theta equals time. Vega models how the spread price will react in regards to changes in the implied volatility of the underlying. So Vega is volatility. V, T, theta, time. That's how you can remember them. Both theta and vega directly influence the extrinsic value of a Nadex spread. And we've gone over that in past webinars too, where it has the intrinsic value and an extrinsic value. And in a spread, due to its combination of two different options at different strike prices, extrinsic value can be both positive and negative. So here's a simple graph of a spread price based off time and how it changes. So let's just say down here, let's just say this was a long spread and this was at the money. You can see how we've covered this before. It's all extrinsic value over here. There's nothing intrinsically. The spread is not worth anything intrinsically. Everything you're paying for is time value. And over time, it changes. You see here with 60 minutes to go, it's worth more than it is with 10 minutes to go, worth more than it is with 5 minutes to go. This is time decay. This is the value of the extrinsic component decreasing if the underlying is just staying at the same point. Let's go all the way up here, and I call this area the theta capture area, and we'll go into that in a future webinar also, but you'll start to understand it now. Because this is where it's intrinsically worth something, okay? If this was a 100-105 spread, then it would intrinsically at 105 be worth $5. But you can buy it at a discount prior to expiration. Why is that? Because the extrinsic value is negative. So this would be intrinsically worth $5, but with 60 minutes to go, maybe you're buying it about just under $4. Let's call it $3.80. If the underlying were not to move, time as it passes, time decay actually helps you up here. Where it hurts you down here, it helps you up here because the spread, if the underlying stays right at 105, every minute that technically passes, you make some of that extrinsic value, so the spread increases in price even if the underlying's not moving. Here, the middle point we call the null point because there is only intrinsic value, there is no extrinsic value. All these lines cross this expiration axis at that time. So that would be on this graph at 102.50 or approximately 250 intrinsic value. There is no extrinsic value. So there would not be any time decay at that point. All right, so the prior slide, we just went over a clear example of the concept of theta, where it's negative and where time hurts you, where time helps you, and where there is no extrinsic value at that null point. Let's just review this one more time. Theta is a sensitivity of the spread price to the passage of time. Time always decreases, therefore theta is the only unidirectional Greek. You can't magically add time back to a spread. You know, if it started with 2 hours expiration, then it's 1 hour 59 minutes, 1 hour 58 minutes. All of a sudden, it's not going to jump back up to 2 hours to expiration. That would be a new spread. That would be a new initiated spread, but it would not be the spread you're in now. Theta can both help and hurt the spread trader depending on where the position is put on. I already showed you where time passage hurts you because theta is working against you because the extrinsic value is decaying over time. And I showed you an area on the spread where the passage of time can help you because the extrinsic value was negative there and theta is positive, so every minute that passes actually helps you. You earn that time back. It essentially puts that money back in your pocket. There are strategies to capture theta and take advantage of time decay during certain market conditions. One of the reasons we're teaching you guys all this is because there's not one best place. I'm just going to get this question seems to come up in the webinars we do. Well, what's the best place to put this spread on? There is no one best place. You need to understand the delta, the gamma, the theta, and the vega, and then how it interacts with different market conditions. Are you expecting price to, is the underlying in a momentum market? Well, then there's a certain optimal place you can put on a spread. Is the underlying gone stagnant and it's not really moving? And is volatility going up, volatility coming down? So the point is, all this is to understand how these Greeks affect the spread at different places. So then as you become more and more advanced trading of a trader, you can learn, okay, these market conditions, I know theta, it works in my behalf at this point, so this is the market conditions where I might want to put that on. Here's the graph of theta, okay? Now remember, this is the 100-105 spread again. Remember we talked about 100 would be at the money for a long, if we were going long the spread, that would be at the money. Remember, it was only extrinsic value, and every minute that passed, the extrinsic value would decrease. That's what this is showing. It's actually maximum theta negative at the money if you're long the spread. Remember, we talked about when we were in the money all the way at the full intrinsic value, and time was working for us. That's because this theta is positive. So you can see how that graph. We talked about the null point. There is no extrinsic value, so there can't be any theta there. That's where this crosses at 102.5. Now, as you approach that at the money position, you can see how your time decay increases. And this is a snapshot at one specific moment in time and at a specific implied volatility. As time also changes, your theta curve does change, and as implied volatility changes, your theta curve does change, and we will get into that. So you can see how as you approach at the money, your theta time decay becomes greater and greater, and then as it approaches null point, it's still negative, but it approaches that zero. As you pass that null point, time decay starts working for you if you're long the spread, and continues to work for you all the way, no matter how high the underlying goes. Because the extrinsic value is negative, this theta is adding back in, so the extrinsic value is becoming less negative every minute that passes. So you see, I'm putting the spread price versus time next to the spread theta. See where it's negative, it moves this down. Where it's positive, it moves it up with the passage of time. That's how you can see these working together. So in the prior slide, we saw theta can help the trader who is long the spread near the ceiling price. Theta, however, hurts the trader who is holding the spread near the floor price. The opposite is true if the trader has on a short spread position. So now we're assuming that the underlying is also not moving. So if it's, when I say theta, however, hurts the trader who's holding the spread near the floor price, time decay is always going to work against you, but that can be compensated for if the underlying is trending in the direction. So if you're long the spread and the underlying is trending up or moving up in the direction that you put on the trade, the underlying moving up will help offset some of that time decay, but you're still experiencing time decay. Just as if we're above that null point and close to the ceiling price, and you're capturing that theta, but if the underlying starts trending down against you, you know that spread price is still going to go down, but the positive theta can help offset that. But you can't count on it offsetting all of it. I mentioned also theta changes over time. So we looked at it at one specific time, but you can see how as time gets closer and closer to expiration, the theta gets more and more extreme, both positive and negative. So with 60 minutes to go, the time decay is not as substantial. With 30 minutes ago, it's a little more substantial. But as you get into these 5 and 10 minutes, look at how it really starts accelerating. So time decay hurts you more and more as it gets closer to expiration. It's also true working for you. Here's the null point. We're now near that ceiling price. As time passes, it helps you a little at 60 minutes ago, a little more at 30 minutes, but when you get down to 10 and 5, it really starts helping you. It amplifies. So keep that in mind too, that the effects of time really amplify on the spread price changes closer and closer to expiration. So let's just summarize our key takeaways of theta. Theta is lowest at the floor price and highest at the ceiling price for a long spread. The opposite is true for a short spread. At the midpoint, theta is 0. That's because there's no extrinsic value. Theta is amplified closer to expiration, meaning it gets more and more severe, either for you or against you, depending on where you have the spread on. For long spreads, theta near the floor becomes more negative as expiration approaches and more positive near the ceiling as expiration approaches. The opposite is true for short spreads. As with the other Greeks we have examined, the absolute value is not necessary to know. It is more important to understand where theta is the highest and the lowest, positive and negative. Traditionally, for options, theta is measured based on the passage of a day. However, for Nadex spreads, we can measure theta with the passage of time in shorter increments, like a minute. If a Nadex spread has a theta of negative 0.05, then every minute passes, the spread will lose a value of 0.05, or that would be approximately 5 cents. If a Nadex spread has a theta of 0.01, then every minute that passes, the value of the spread will increase by 0.01 or 1 cent. I also mentioned how volatility, we have implied volatility in the options pricing model, which therefore is in the spread pricing model, since this is made up of options. In the past slides, we held implied volatility constant. In this slide, we're changing the value of implied volatility. So this is our graph, this is our theta or our time decay graph. Again, here's where it's positive, or here's where it's negative, here's where it's positive. Now we're adjusting the implied volatility of our model. So we're holding time constant. Let's say this is with 30 minutes to go. We're just adjusting the implied volatility. If implied volatility goes up, it sort of shifts the effects of theta more above the ceiling and below the floor, and it also amplifies the effects of theta. As implied volatility goes down, it brings it closer to at the money if you're long, or the ceiling price if you're long, and it decreases the effects. So less volatility decreases the effects of time decay. More volatility increases the effects of time decay. That's really what I want you to take away from that. So you know if the implied volatility is going up in the option model, which could happen if the underlying volatility is going up, or if you expect a big report to come out, then it's going to amplify the effects of theta. If, however, a big report just came out, or a news release or something that the markets were waiting for, and they weren't moving around much, they were stagnant, and then everybody shrugged off, said, oh, that's no big deal, and then so we had really high implied volatility, and now all that implied volatility gets sucked out because the underlying is not moving, and the implied volatility in the market, let's say, drops from 40 to 10%, it would have an effect on the theta, meaning if you were long up by the ceiling, time decay wouldn't be helping you as much. It would still be helping you, but it wouldn't be helping you as much. And if you were near the floor and long, it wouldn't be hurting you as much as that implied volatility goes down. So volatility amplifies the effect of theta. It's most extreme just below the floor price and just above the ceiling price. Now let's get into Vega and how implied volatility affects the spread. The definition of Vega is the sensitivity of the spread price to changes in the implied volatility of the underlying. Remember how we said before that generally volatility and time had the same effect on the spread? There is a slight difference when it becomes to Vega. When we covered that with the Greeks, with delta and gamma, and I even showed it to you with theta, how time and volatility roughly sort of mimic each other, it's slightly different with Vega. So here's our spread price graph versus volatility. Looks very similar to the time. Now we're holding time constant. Let's just pretend this is with 30 minutes to expiration. The only thing we're changing here is the implied volatility, all right, of the spread. If we're long and we're at the money down here, and implied volatility goes from 10% to 40%, the extrinsic value increases. The spread increases in value even though the underlying is not moving. By just increasing the implied volatility in the option model, the spread price will increase because it will contribute more extrinsic value to the spread. The opposite is true. If we were at 40% volatility, the underlying does not move and the implied volatility drops to 10%, it decreases the extrinsic value. So the spread would lose value with just the implied volatility changing. Here at the null point, again, no extrinsic value, you have no Vega component. Whenever there's no extrinsic value, you can't have Theta or Vega. We're up here. Let's say we're long near the ceiling price. If volatility drops from 40 to 10, it helps us. This really helps us because it actually shrinks the extrinsic value, and the extrinsic value is negative, so you start capturing more of that intrinsic value. However, if implied volatility goes from 10 to 40% without the underlying moving, it would hurt the trader who's long the spread. That's why I'm saying you can't just say where's the best place to put on the spread, because you have to take into account the time remaining to expiration and especially the implied volatility of the spread and what your expectations of the implied volatility are going to do. Are they going to increase? Are they going to decrease? Or are they going to stay the same? Those kind of things can really affect the price of your spread. So the prior slide is a clear example of the concept of Vega. Vega can both help and hurt the spread trader depending on where the position is put on. There are strategies to take advantage of both increasing and decreasing volatility. This is important to understand around predetermined news events or reports. It's really important. Or when the markets go quiet, like maybe during lunchtime, or maybe the currencies, early evening currency trading. It's generally very quiet. You want to understand how very low implied volatility is going to affect your spread price. So here's how the Vega curve looks. Okay? So it was positive. Now we're along the spread. Down here's at the money. It's positive. So it's actually looks the opposite, okay, from the time decay curve, from your theta curve. This actually looks opposite. This is where if you're long down here and increases in implied volatility will help you, just as increases in implied volatility will hurt you up at the ceiling price. As with the other Greeks we've examined, the absolute value is not necessary to know. It's more important to understand where theta is the highest and lowest, positive and negative. Vega is measured versus percentage increases in implied volatility of the spread. Implied volatility is determined by market makers and is correlated with historical volatility and actual current volatility of the underlying that is traded, but not necessarily the same as the historical volatility or the current volatility. It's based off also future expectations. So if they expect the market, even if the market is not volatile yet and the market makers expect it to get a lot more volatile, they're going to put a higher implied volatility in their model, which is going to affect the price of the spread. If it's been very volatile and they expect it to go quiet, they're going to reduce the implied volatility in their model, and it's going to affect the price of the spread. So if a Nadex spread is a Vega of 0.05, then every percent the implied volatility increases will increase the value of the spread by the 0.05. If it's negative 0.05, then every increase of implied volatility of a percent will decrease the value of the spread by 0.05. Here's how this looks side by side. So as here down at the money, long spread, it's most positive, and remember the purple line was 40%, 30%, 20%, 10%. So you can see how if implied volatility goes up, this is why this is positive up here. It actually adds to the value of the spread. Here it hurts you. as implied volatility goes up. Remember 10, 20, 30, 40. So if you were long up here and implied volatility goes to 10 to 40, see it's actually making the extrinsic value more and more negative, so the spread's actually dropping in value because you have your intrinsic value, and the more negative the extrinsic value does, it subtracts from that. So if you were long here and the only thing that's happening is underlying's not moving, but implied volatility is going up, up, and up, you're going to see your spread price moving against you, even though if the underlying is not moving. So in the prior slide, we can see how an increase in volatility helps the trader who is long a spread near the floor price. Conversely, an increase in volatility hurts the trader who is long the spread near the ceiling price. The opposite is true if volatility is decreasing, and the opposite is also true for a short spread position. Time also affects Vega. So with 60 minutes to go, you see your Vega curve is a lot higher. Again, we're long. Here's at the money, so just below at the money. The increase in volatility helps you if you're long, but as it gets closer and closer to expiration, it does not help you as much. Down here, just above the ceiling price, it's most negative. And as time gets closer and closer to expiration, any increase in implied volatility does not hurt you as much. So Vega is highest at or just below the floor price, and lowest just above the ceiling price for a long spread. Opposite is true for a short spread. At the midpoint, Vega is 0. Again, there's no extrinsic value at the midpoint, or what we call the null point. So if there's no extrinsic value, Vega has to be 0. Sorry about that. Vega decreases as time approaches expiration. So the effects of volatility decrease both the benefits or the detriments as the spread approaches expiration. For long spreads, Vega near the floor decreases as time approaches 0, and Vega near the ceiling decreases as time approaches 0. Volatility also affects the shape of the curve, but it really just shifts it slightly. Okay? So this is included for the point of completeness. You can see both at the money and at the ceiling price. It changes it a little, but the real effects of the volatility on the curve push it out farther above the ceiling and farther below the floor. That's really the point of that slide, to show you just for completeness. So an increase in volatility positively affects Vega most when the price is below the floor price. An increase in volatility negatively affects Vega most when the price is above the ceiling price. This is true for traders who have a long spread position, and the opposite is true for traders who are holding a short spread position. So let me turn this back over to Bob real quick, and he'll go through a wrap-up, and then we'll answer any questions.
Here's what I think is interesting for you guys to remember, is that when you saw that the volatility can be moving against you, if you're in a long position that you've had for a bit, and it goes in your favor, and you're almost up at the ceiling price, and then volatility starts creeping up, but the market's not moving. Let's say we're coming up to some sort of data release. One of the ones I always like to mention is rig counts on a Friday. Let's say you're long crude oil, the trade's gone your way, and everything's kind of slowed down. Time is moving in your favor, and all of a sudden the volatility starts to pick up because of the uncertainty of the release of rig counts, and you start to wonder, well, why am I losing money? The underlying's not actually moving. Or why is the value of my spread decreasing? I'm in profit, but now I'm in less profit. This is why. And this is why Mike said it's more important that you understand what's happening than you know the absolute value of Theta and Vega. Because you see it and you go, okay, well, volatility is clearly picking up because the underlying is not moving, time is working in my favor, but Vega is not. So that's the thing you have to understand, and that's where you make decisions as to whether, we've always talked about one of the advantages with Nadex is they allow you to exit binary and spread positions, obviously. We talking about spreads right now, but you need to know how these Greeks affect your position. Otherwise, you don't understand exactly what's happening while you're in the actual trade. You may need to review this information multiple times. It's not necessary, again, that you worry about the absolute value of the Greeks while trading the Nadex spreads, just that you understand how changes in price, time, and volatility can affect your spread position. So in this webinar, we covered Theta and Vega in a fair amount of detail. We examined how the underlying price, time, and volatility changes affects the spread price. All this will play into how, when, and where a trader puts on the Nadex spread. This will give you an inside track to establishing Nadex spread positions that are specifically aligned with the different trading strategies and designed to successfully capture certain market events. So this is us. Again, follow us at Pat Trading, Pat_trading. Follow us on Twitter, like us on Facebook, and visit us at Pat Trading Partners. There's a lot of free stuff on there for you guys. We're happy if you guys just sign up and take the free stuff. As I mentioned in the risk disclaimer, we're not trying to solicit. But I would like, it's not on the slide, but I would like you guys to listen to the Money Path podcast, because we cover a lot of things. It's the Money Path. You can find it on iTunes, Android. That's a podcast that me and Mike and our colleague Stafford do that I think you guys would like a lot. Happy to take any questions. Go ahead, Mike.
They can just, if they go to Path Trading Partners, there's a tab for the podcast, so they can get it directly there too.
Yeah, and then again, if you don't find our archives on Nadex's website, they're at Path Trading Partners as well. But sign up, get on our list. We don't email a bunch of crazy stuff out. We only email out when we have something going on, or if there's something special Nadex is doing. Otherwise, we won't bother you guys. Get on the website, and again, any questions, we're happy to answer them. Otherwise, we don't want to take up any more of your precious time. So we'll wait a few seconds, see if there's any questions. I'm seeing some people exit, so we'll wait a few more minutes. Otherwise, we will say goodbye to you guys and thank Nadex again for allowing us to chat with you.
How does the movement of the underlying affect the Greeks, and which of the Greeks is affected the most? How does the underlying movement affect the Greeks? Sort of a tough. I'm trying to think how to answer that.
Yeah. It's not a direct relationship like that.
No, it's not a direct relationship. I mean, it's like really where the underlying is in relationship to the spread determines how it affects the Greeks. Okay.
That question is kind of worded not backwards, but indirectly. Like if you take delta, for example, right, and try and fit it into that question, you can't really fit it into the way the question is worded. Again, I didn't see that question, but whoever asked it, go back and watch the other webinars that we did, because again, essentially the movement of the underlying, it obviously affects the price of the spread itself, but it, like delta, shows you how much the movement of the underlying will affect the spread price.
Move the spread price, and
then
and you also want to understand how the underlying is in relationship to, you'll really want to review the at the money, the in the money, the out of the money concepts, and intrinsic and extrinsic value, because where the underlying is in relationship to the floor price or the ceiling price, you know, is going to determine what that intrinsic value is, and therefore, you know, if it's in the money, if there's an extrinsic value, then how the Greeks play into that extrinsic value, just as we went over in this. If volatility changes or if time changes, is that working for you or against you and helping or hurting that extrinsic value component?
I look at the Greeks as like an instrument panel in an airplane, right? I mean, you're going to take the airplane from destination A to destination B. And the Greeks help you decide what the best path to that is. No pun intended, because we're path trading partners. But the Greeks help you. The Greeks tell you the wind speed, and if there's any sort of obstacle in your way, and then you call the tower to see if there's other planes in the way, and you determine the best path based on what the instruments are saying. That's really the way that I look at the Greeks. So it's not a matter of sort of which one affects it most, because that kind of begs the question, which one should I look at most? And that's not really a trading question, right? Because they're all important.
Right. We just sort of left out the one that affects things the least, which was rho, because you don't really need to know that. Everything else, the three that I'd say you really need to focus on are understanding delta, theta, and Vega. All right. Gamma is, if you can get gamma in, it shows you how delta changes, but it's not the top. So, delta, people really need to understand why their spread doesn't move 1-for-1 with the underlying. They need to understand that, and that's how delta will play into it. Theta, which we went over this time, how the time decay can either help or hurt you or not even be present if you're at the null point. Vega, how increases or decreases in implied volatility either work for you or against you. So those are the three main components that you're going to want to attempt to grasp to become a more advanced spread trader, because then once you understand those and understand sort of market conditions and understand how market conditions, your trading strategy, and the Greeks affect the spreads, you can then have the whole package to say, okay, based off these kind of market conditions, I got this trigger to go long. But I also think that implied volatility is going to be decreasing, and I know how much time we have to expiration, and I know approximately where I am on the theta curve, so I want to initiate a spread at X position, or I want to look for a spread near that. I want to try to find a spread that matches my outlook and not just, oh, I have a buy signal, I just need to go long a spread, because there's different spreads you can go long. The underline's going to be trading in different locations in those spreads. So that's the real nuances of, as Bob said, the instrument panel. The instrument panel is going to help you take the right path, take the right course of action, because you now understand how to read those instruments instead of just, I got a buy signal, I got to go long, or I got a sell signal, I got to go short.
The example I used on the crude oil trade was an actual real question, where it wasn't rig counts. I think it was the Alberta fires, the Canada fires, where a particular student of ours was actually said he didn't understand why the crude oil price wasn't moving much, but he was losing money. And that's because news of the Alberta fires was starting to leak and volatility was starting to creep up before the price did. So he actually started to lose money on a spread and he couldn't understand why. Then it really is important to understand why, so that you know what your course of action should be, more so than what the actual level of volatility was before he saw his position erode in value and after. The number doesn't matter. Whether it went from 20 to 25 or whether it went from 5 to 10 or whether it went from 50 to 100 doesn't really matter. It's understanding why it happened. Price wasn't moving that much yet. Volatility was clearly spiking. Anything else, guys? All right, guys, thanks again to Nadex for letting us chat with you. Thanks for being here. Visit us at Path Trading Partners. Again, there's tons of free stuff you guys can sign up for. And if you decide to buy something, wonderful. But if you don't, we're happy to have you as members either way. And
Thanks, everyone.
Please, the Money Path Podcast, look it up because it's my favorite thing. Cheers, guys. Thanks, Mike.